This episode is brought to you by Elevate OS, the only all-in-one community operating system. Elevate OS transforms property management, combining resident engagement, reservations, rent payments, maintenance, and concierge services into a single super app. It also uniquely integrates access control, intercoms, package lockers, and thermostats, eliminating app fatigue and redefining modern apartment living. Visit elevateos.com/MMN for a free demo and see how they can help you level up your operations. It is that time again at the Multifamily Collective where it is tradition for you to go and grab your favorite beverage. For me today, it is Humbler from Proud Mary Coffee Roasters in Portland, Oregon. And your favorite writing utensil, because we are getting into a long form interview. And today's guest is Chris Grinzig, a guy who moved from New York to Florida in 2020. He bought a 16-unit property with zero property management and construction experience and just figured it out as he went. Fast forward to now, he's built JAG Capital and JAG Property Management, acquired 150 units in Jacksonville, and runs everything in-house from acquisitions to renovations to leasing. We get into the behind the scenes of managing value add deals, dealing with contractors, keeping residents happy during construction, and why Florida's multifamily market has room to run. If you've ever thought of getting into real estate or leveling up what you're doing now, this is the episode for you. I learned a lot. Now, I've operated in big multifamily firms for a very long bit of time, nearly my entire career. But when I first started out, I was in the single family home sales business, and I started buying up little properties, single family homes, fourplex, duplex, eightplex, and that's how I got my start in the real estate industry. So this took me back to that moment in time where I was doing direct investment in the deals myself and doing all the work. So Chris took me back, a trip down memory lane, but he also talked about things that are germane to this present day and how it's been to operate in the multifamily space, especially in this tough economic environment, which I think will give way here in the next, 12 to 15 to 18 months. So again, grab your favorite beverage, grab your favorite writing utensil, your favorite thing to write in, and enjoy this episode with Chris Grinzig. Chris, welcome to the show.
Yeah, thanks for having me on.
Excellent. I took a little bit of time to learn a little bit about you, and I'm very excited about this conversation. And I thought maybe we could kick it off. You're from New York, and in doing some research about you, I learned in the very early innings of your real estate career there was sort of some, I'm going to call it a false start, or maybe a little bit of a challenging start. And I'm wondering if you can just maybe talk about your origin story, but then maybe crescendo that with, hey, I got into the real estate business, and in the early innings, it was a little bit difficult, and here are some of the lessons I learned.
Yeah, for sure. So I got introduced to it back in 2016. I graduated college in 2014. I was kind of bouncing around jobs a little bit. And my aunt and my cousin had this, my mom and my cousin had decided to buy a flipping course. And they knew I was still trying to figure out what I wanted to be doing with my work and career, things like that. So they invited me along and said, why don't you come to the seminar, see if it's of interest? And I was like, sure. It was just like a weekend thing. So went to that, thought it was interesting. The three of us all started trying to work together, flipping houses near us, Long Island, New York, and had zero success. We found it very difficult. The flipping platform that we were on, some of the tools weren't out of the box probably right for that market. I think we definitely could have adjusted it to fit, knowing what I know now. At the time, it was very difficult. And a big part of that program was also having a mentor who could help you with those things. Our mentor wasn't in a similar type of market. They were several hours away. So it became difficult in some of those conversations to be like, look, a kitchen isn't going to cost you $6,000 back then. It's going to cost you 15. And now it's like 15 is like standard. But up in New York, it's probably more just because labor was a lot more expensive up there. So we found it very difficult at the time. Again, I definitely think knowing what I know now, we could have adopted it better. Or if we really wanted to stick to that, we could have. However, as we got more exposed into real estate, we learned about different things. So some people were flipping out of state. So we started looking at that. We started looking at flipping in upstate New York or in Jersey or in Pennsylvania. And we really started looking more into Pennsylvania because you could start getting into less high income, high cost areas without going too far. And we met a guy who was working on a flip there. And then we ended up meeting his cousin. His name was John Cohen. And John had started years prior to us doing wholesaling, then tax deeds down in Philadelphia. So he kind of, but he was moving out of that and into small multifamily. And then he was shortly thereafter, he moved into larger multifamily. So we looked at then doing the tax deed stuff down in Philadelphia, which we hated. Me and my cousin took a drive down there one day and we were driving all the stuff for auction. And it was some of the worst areas I've ever been in, some of the worst property I've ever seen. And while there was probably good opportunities there, it just wasn't what I wanted to be doing with my weekend and my life. I was just like, this isn't what I want to do. My cousin also had, I think, his first or second kid at the time. So he was basically like, I can't do this anymore. So it's just going to be on me to be the one driving all the time. So I was like, no. So then we started talking to John more about the multifamily stuff because we thought that was interesting. And that kind of fit with a lot of the things we were looking for. We could do it out of state, but it had a little bit more scale. So there's a little bit more professionalism, a little bit better of a team you could kind of build. You didn't have to have like such crazy consistent deal flow where if you were flipping out of state, you might need to do 1, 2, 3, 4 deals a month to really kind of build up that team and keep that engine going. So it just kind of fit. He was willing to work with us. So we partnered on a couple small deals up in Covington, Kentucky, right outside of Cincinnati. And then while we were doing some stuff together, because we also started a meetup together, and then we did some other things, I really hated my job because I was doing this all on the side. And I was talking to him one day, and we connected on a lot of things because he was only a few years older than me. He had played baseball in college. I played soccer in college, and he had kind of transitioned out, and he had formed Toro with his partner, Don, and they were targeting larger multifamily deals. So I think they had 3 deals at the time under contract for a total of like 500 units or something in the Carolinas. And I was like, hey, what do you think about me coming to just work for you guys on a trial basis? Like, let's see what happens. So we talked to Don. I came on for 3 months making like $500 a week or something like that. And then 3 months turned into 4.5 years. And then eventually that turned into me leaving that after 4.5 years, moving to Florida and starting my own company, which we're coming up on 5 years of that.
Well, congratulations on that.
Yeah.
That's fantastic. I'm curious obviously taking a job like that, making $500 a week, there's certainly, you need money to live, you need money to feed your family. But if you had to put a value on that education, that 4.5 years that you mentioned, what kind of value would you place on that? Just hanging around those guys and doing those deals and working the real estate.
Oh, it was huge. And 500 a week didn't last super long. That was like the first 3 months. So I got paid decently well and then pretty well, in later years. So it wasn't super long. And I was in a fortunate enough position where I was single. I was living in very cheap housing. I could have lived at home, but I really wanted to be on my own. So, and I had a little bit of savings, so I could do that for 3 months. And the job I was already in wasn't paying me a ton. I also had a part-time job on top of that too. So I did what I had to do to make it work for 3 months, but we then had the conversation turn into a job. But even still, the information that I got was so, I probably still undervalue it to this day because I was in the office 9 to 5, 8 to 5, 9 to 6, whatever it was, 5 days a week for 4.5 years, listening to 2 guys talk amongst themselves with brokers, with lenders, with investors, with other owners all the time. And it was a small company. It was the 2 owners, myself, and an admin the entire time I was there. I think we had an intern at one point. And we all sat together. So anytime they would have phone calls, a lot of times they'd be on speaker, so I'd even hear both sides. But even not, I would at least hear them talk. And it gave me, especially early on, the opportunity when they would talk to somebody and I would hear something I didn't understand. I could be like, hey, you got a second? I would just want to ask you a quick question about that. And almost every single time, as long as they didn't have something else, they would say, yeah, let me, we talk through it and I'd understand. And then, so a lot of those early principles I was able to absorb through repetition and really understand it intrinsically versus just reading about it, hearing it on a podcast, taking a coaching course. It really was a tremendous benefit to me in that early stage to really build a foundation on and then grow from there.
It's interesting. I think this is my 30th year in the multifamily industry, and I look back over the course of my career, and it's hard for me to put a value on the mentors that I've had in my life and the impact that they've had on my ability to do business. And I think I don't know that everybody undervalues the mentor relationship, but if I could encourage anyone, and I think you're a testament to that, get yourself a good mentor, and then take advantage of those moments in time where you can ask them questions or get them to explain things to you or just support you in some way, shape, or form.
For sure. I think I say undervalue it because it's tough to know what my life would have otherwise been without it. So it's really tough for me to know the made up scenario where I just started doing real estate on my own without having that direct oversight. I probably don't realize how helpful it actually was, because I think most people, when they don't have that, they kind of do the natural progression of like working up, right? You start with like a flip, then a rental, then you move up into multifamily. In like a weird way, I've done the reverse, where I started on, I quickly moved up into the, 100 to 500 unit stuff. And for the last 3.5 years there, I ran everything in our Florida region. So I did acquisitions, underwriting, I did our models, I put together our investor books, I helped raise equity, I helped place the debt, I helped do the insurance. I mean, I did pretty much 80-90% of the job. The only things I really didn't do was I didn't do a ton of the equity raising because I didn't have the network. And that was really, the principal's job. They're the ones putting their name on the stuff. And also the stuff that requires the principal, right? The finalizing of the insurance, the finalizing of the debt, the finalizing of the PPMs, the operating agreements, things like that. I was involved. I knew it. I would help facilitate those things, but I wasn't the one doing that actual stuff. So for me, I had a little bit of a different track where I actually went larger first, and then I've kind of, I don't want to say like moved down the path, because I don't really think it's that, like, I don't necessarily think bigger is necessarily better, but I think I was exposed to a more financial outlook of how it works versus like a back of the napkin outlook. I don't know how to put it in precise things, but it's just a little bit different than I think most people's trajectory. And I think that's some of the stuff that I undervalue because I don't know anything else about that.
Yeah, that's fair. Makes sense to me. Let's shift gears a little bit and talk about, you're down in the Florida market, Orlando, Jacksonville specifically. I read something recently where you're talking about the dynamic of, obviously there's been a ton of supply that's been put into the marketplace. That's all over the country, but I think Orlando certainly saw some supply elevation, and maybe the same thing for Jacksonville. But then you still got, or I think you still have good, healthy demand, but rents aren't accelerating at the pace that they did, let's say 3 years ago, plus minus. Just talk to us a little bit about those two markets and what you see as opportunity and maybe potential headwinds.
Yeah, so I can definitely speak more to the Jacksonville market going back to late 2016, early 2017. That's kind of when we started. For Toro, we acquired 1,000 units there. I oversaw it. On my own, we've acquired 150 units there. So we still own 51 in the market, and we still manage it. And then we manage for other owners as well in the Jacksonville and the Orlando market. So I just have more history in Jacksonville as well as owning properties there. Florida always had really, since I've been in the market in 2016, always had really strong rent growth, both in Jacksonville, Orlando. But I mean, you throw a dart at Florida and it always had pretty much strong rent growth going back to 2016. Jacksonville was kind of always the redheaded stepchild to Orlando and Tampa. And we always liked that early on because you could still get really good cap rates in 2016 to 2018 compared to Orlando. At the time, interest rates were 4 or 5%. So you had good positive leverage with upside. That changed from 2018 to 2020. Cap rates dropped a ton. But you still had some good opportunities, but you had to be careful and kind of pick. And then 2020, kind of through COVID and then really post-COVID, is when things really exploded in Jacksonville. There was already a lot of development in Orlando. It always attracted a lot more national attention. Nothing too crazy. It always seemed to be able to kind of sustain its momentum of people coming in and being able to absorb the markets coming into that market in particular, Jacksonville never really had as much attention. 2020 came around. I think a lot of people woke up, and then combined with the explosion in rent growth right after COVID. I mean, we were seeing 20-30% year over year rent growth from like 2020 to 2021. And construction costs were still fairly low. Cap rates were very compressed on what people were buying things for, and interest rates were extremely cheap, especially for like floating rate bridge loans, which was like in the 3% range, 3-4%. I think even some were even lower because it was like a spread over. I don't know. It's kind of a fog a little bit now. Almost feels like a fever dream a little bit, that kind of period.
Right.
But it got so much attention. Jacksonville in particular was top 10 in the nation for number of new housing units being built as a percentage of the existing supply. So it wasn't necessarily delivering the most units total in the country, but as a percentage, it was top 10 for about 2 or 3 years. And that amount of supply started coming online in late 2022, because obviously when you start a development, you have to get your permits, you got to move dirt, you got to do utilities, site work, and then you go vertical, and then you finish, and then you lease up. So all of a sudden, after 2-3 years of when these projects really started ramping up, that's when we started seeing a ton of supply coming online, and the supply started outpacing the demand in the market and the new people moving there. And late 2022, early 2023 is when we started seeing rents plateau, a ton of concessions enter the market, and then rents really started dropping. So we've had rents drop anywhere from 15 to 25% from their peak in kind of 2022, depending upon the property, the submarket, the floor plan, things like that. And we're still seeing today even a mixed bag. So we have some properties in the historic district in Jacksonville where January, February, March of this year, our 1-bedrooms were flying off the shelves. They were doing extremely well. And then about 5-6 months later, during summer, which is usually a very good time for leasing, they really struggled. And we had to drop rents a little bit more even from there. So even today, it's still very much a very weird market in terms of vacancy, concessions, and leasing. I would say overall, it's kind of stabilized and bottomed out a little bit. And then there's a lot of indications of it kind of turning around, right? When 2022 and 2023 hit, interest rates had jumped up, insurance rates went insane, construction costs doubled or tripled, and your amount of new construction projects that started in 2022 dropped precipitously. So if you look at that same 4 or 5 year time frame, if it takes 2-3 years for it to be built and start leasing up, well, everything kind of shut off in early 2023. So now 25, 26, 27 is when a lot of people are seeing that pipeline is disappearing overnight. So there's still everything that's been built. So the amount of supply is bigger now. So it will take time to shift if it indeed does. But there's not new stuff coming into the market. And we're still seeing the population and the job growth in the market. So a lot of people are projecting and expecting supply and demand to start swinging back the other way. We haven't really yet seen that actually come into the market. And some people were talking about it possibly happening kind of Q2 of this year, the second half of this year. And I really haven't seen it. But, we don't have a massive portfolio. We're not managing thousands of units, but the stuff I've seen, and we're obviously tracking comps and other things going on, it's still kind of been the same from the beginning of this year to now.
Yeah, makes sense. Thank you for unpacking that for us. I was driving in this morning and I was listening to a podcast, and I think it was Jay Parsons' podcast, and he was this little I don't know what you'd call it, but most people were trying to survive in 25, fix in 26, and enjoy heaven in 27. That's the way that he put it.
Yeah, they're keep coming up with these new little rhymes and stuff. I haven't heard heaven 27 yet, but that's what at least a lot of brokers are selling right now.
Right.
We'll see what actually materializes. It tends to feel like things take a lot longer to actually happen than they do, and it feels like we've kind of all just been sitting around waiting for it to actually happen.
That's
and right. We're still just trying to manage the day-to-day right now. And, each unit, each property can be very specific and different, and trying to, minimize vacancy, speed up leasing timeframes, minimize turn costs, all those things for our own properties and other clients.
So that's a good segue. I wanted to talk about operational strategies. And so the entire time I've been in this industry, I've generally worked for companies that own and operate multifamily communities that are, say, 200 units plus or minus.
Mhm.
And so from a labor perspective, it sort of optimizes somewhere around 200, 250 and on up, right? So you can put the right labor on site to actually do customer service and get service requests and things of that nature done. I've always been intrigued because every time we've tried to go downstream, so to speak, in terms of unit count, we find it very, very difficult to operate those deals effectively. And I'm just curious, you from what I've read and researched, you work a little bit in that niche. And I'm just wondering if you also manage some of the bigger buildings, what makes a successful, say, 51 to 100 unit operator versus the 250 plus or minus for a big multifamily operator where that's kind of optimized?
Yeah, so we play in like the single, like we manage like single family homes, townhomes, all the way up to like anything that doesn't need on-site staff. So in Florida, you kind of see like 60 to 80 units. You start seeing office space pop up, or maybe an owner wants to stick somebody in a unit and keep it down. I wouldn't personally do that, especially now with my experience operating it. I don't think it's necessary. I want to preface this with I've never done property management with like operated it with on-site staff. So my experience is just from the asset management side, but I can kind of extrapolate a little bit.
Yeah.
So I'm a little bit naive in that space, but my understanding is, when you're 250 units plus, you have, taking out maintenance staff, but it is important. You probably have 3 people on site, and you can you can segment that into specialists, right? You have a leasing person, assistant manager, and property manager.
You got it.
Property manager is doing financials and liaison with the central office and the owners. Assistant manager is doing all the tenant relations stuff and helping with maintenance. And then you've got your leasing agent who's just get these units rented and let's renew them. And when you dip down below that space, when you only have 1 or 2 people, now you're asking one person to do a lot of different things. And when I was at Toro, we were in that space, that 100 to 300 unit space. Most of them were 100 to 200. So I'm also very familiar with that on the asset management side, where we primarily only ever had one person on site. And you were asking them to do a lot of different things. And we would have one property that would be doing really great at like collections, and another one that would be doing really good at maintenance, because those managers were better at different parts. Yeah. And I think that's part of the problem in that 100 to 250 unit space. My gut tells me this. I don't know if it's exactly true, is that you're asking one person to do a lot of different jobs, and one person is probably better suited for a portion of that. Yeah. I also think partially too, in the property management world, the salaries aren't as high for the type, you're running a building that might be worth $10-20 million. It's got, millions of dollars in revenue, and you're paying somebody $50-ish thousand. I don't know what the going rate for on-site staff is right now, but roughly that much. It's, it's not a very huge amount. It's not necessarily a ton of money to live on. So it's not always easy attracting, I don't want to say high quality talent, but somebody that can do all those things really, really well. And then it's also cutthroat, right? If you've got somebody that is amazing at all that, probably going to get poached by a Class A building that has 300 units as well.
Right.
So it's always very difficult to find and retain talent in that space. What is actually interesting to me is when you dip down below that and you go to the scattered site stuff, as you scale the property management world in that space, you move it. There's a couple different ways you can structure it, but a lot of them are like, and the way we have it set up to do in the future is either like a departmental structure or like a pod structure, where you do have specialists kind of doing those different roles across a few hundred units scattered. So you have a leasing person, you have a maintenance coordinator, you have a assistant property manager, you have a property manager, and they kind of own those areas of those different properties. And I actually think there's a really interesting opportunity. I don't think you could do it as a third party manager. I think you would have to be like an owner operator, where if you could pick up longer term 100 to 200 unit properties in one area and scale, that you could centralize some of those duties to one person, where I don't know exactly what it would be, because I don't know for the on-site person what their best role would be. I think that would be a conversation with somebody who really works in that world and what they think. But like, does that on-site person just do leasing and that's all they do, and your maintenance coordination is done off-site and with your maintenance person on site. Like you could have somebody in a call center, not even in the United States,
Sure.
taking in maintenance calls and dispatching it either to the maintenance tech or to your preferred vendors. There's no reason that person has to be in an office on site. It
That's
can be, so if you could pick up 10 100 unit properties in one area, you could probably have somebody on site doing stuff and then have a couple of those roles centralized off site. And I think that would help make some of those things efficient. But when you're doing it as a third party, because you don't have control over when you're managing and when they're selling, I think it would be difficult to make the business continue to be profitable and carry salaries and things like that. I that's just my gut as well. So I think there's an opportunity somebody could do something, but that's probably a better question for somebody else.
Yeah, it's always intrigued me, mostly because my gut tells me, just to steal the term you just used or the phrase you just used, is that we were geared for 250 plus. And to some of the points that you just made about people wearing too many hats and not being effective at all of those things, germane to those hats, we just couldn't pull it off from a people perspective, from a talent perspective. So, but I think you're right. I think if you use the pod model, you could pull that off with some centralized individuals who are really good at their pointy type work. So, let's talk about, I read something in my preparation for this conversation where I think it's a value in your organization, do the right thing always. And I love that. And I think that's a great value to guide an organization by. But I often think, I've had this happen in the past where I've worked for a third party owner who doesn't align with the value. And you're faced with this sort of do the right thing always, but you can't because you have somebody else going. How do you sort of reconcile that scenario in your head if you've had to do that?
I think it's tough. I think having an upfront understanding of, when we're talking about, managing for other owners, of what they're looking to accomplish and understanding their business plan and making sure that you're in alignment. So ideally, we're talking to somebody. This is more for the multifamily side. For when you're talking single family or duplex, it's a little bit more straightforward. It kind of is what it is. But when you have, 10, 20, 50 units, there's different ways to look at a property and what you're trying to achieve. And, if we come in and I see a property, I'm like, hey, this needs a ton of work. Like, the roof needs to be redone. There's roof leaks, staircases are falling apart. And the owner's like, yeah, we're not going to touch that. I have no interest in doing that because tenants are going to complain and the work's not going to get done. It's going to make us look bad, even if I say it's on the ownership. And we're going to have trouble attracting the types of tenants we want to attract. So that's kind of a little bit of extreme. There's obviously a lot of gray area and nuance in between,
Right.
But it's really just understanding that, like, our ideal client is somebody who is longer term, wants to make sure their property is being taken care of the right way. Yeah, you don't have to necessarily do every single thing the way I think it should be done or team think it should be done, or fix everything directly when it is. But like, we're not going to run properties that are just going poorly or won't adhere to credit standards, or, we have to come up with our way of doing things to make sure that, one, we can operate super efficiently so that way we can be profitable and also keep our fees as low as we possibly can. But also make sure that we're providing housing in a manner that I think is the way it should be provided, right? Because there's a lot of ways to provide housing as rentals, and some people do it one way and other people do another. And I have a strong feeling on how that should be done. And I think a lot of other people feel that same way, because when I've looked at properties to acquire, whether we bought them or not, there's many that are in great shape or ones that we would want to buy. And maybe it was the wrong time. Maybe we didn't agree on price or a million other things, but they're still excellent properties and have been taken care of well. So there's clearly other people who feel the same way. And those are the people that we want to work with. And I think people want to work with us because they know, hey, we see it the same way you do. We speak the same language, and we know that, like, you're going to continue to do this for us. You're not just going to let it go to waste, because we've taken over properties for owners that do want that, and they've had managers in the past that have just let the properties go, and we've had to come in and clean up big problems and projects and re-tenant some properties and do big capex, and it's not fun. And those are really difficult conversations to have with somebody of like, hey, we went there and like, did you realize like this problem is happening and this problem is happening and this person's 4 months late and they haven't paid? And they're like, no, because I couldn't get a hold of my manager in the past, or they weren't telling me everything. And it's like, well, here's the problems, here's how we can fix it, and like, give us a year and we'll turn it around, or 6 months. But it's really those upfront expectation settings with people, and just having a gut feeling, and sometimes you get it wrong, and then you just have a conversation, and sometimes you got to part ways.
Makes sense. I want to, so going back to the very beginning, we talked about some of the lessons learned. And I think it's interesting to get into conversations like this and podcasts like this, and we talk about all the lessons learned. But I'm on the flip side of that, there are some incredibly fulfilling moments as an entrepreneur, or just things that cause joy in your mind or in your heart. And I'm just wondering if you could share a couple of those with this entrepreneurial journey. I've been fulfilled in this way, or I've found joy in this. If you could just share some of that with our listeners and our viewers.
You're asking me a tough question, because I have a difficult time looking back, or like you set like milestones or goals, and I always have a very difficult time like celebrating those or recognizing them. I'm so focused on like, oh, well, we haven't done this yet, or I wish we were doing this better, or I wish we were doing that. And it's always difficult for me at least, to recognize those. So I do think the one that I am pretty proud of is, the first 16 unit we bought down here by ourselves. I moved to Florida not having any property management experience, never directly overseen any kind of construction or renovation, and just decided I was going to figure it out and do it myself. I did have my father who partnered with me on that, and he had a lot more knowledge than I did on construction and renovation, things like that. But he was still, up in New York, so it was kind of working intermediary. And I mean, we spent $35 a door redoing interiors, exteriors. We rebuilt the laundry room from the slab up. There was just electric and utilities there, but we had to rebuild that. I'd never done any sort of like construction work. I'd never seen framing before that. I'd never seen any of that stuff being done. I'd never really dealt with permits or anything. So it was all new for me, and I got many things wrong. And also trying to figure out how to manage, the renovations with renewing tenants, or, non-renewing. And, we had a couple problem tenants when we took over, and things like that. So, I look back, and we still have that property now. We refied it. We pulled out some money, and, it does okay now. Rents dropped after we refied, so it's not as good as it was, but it's still a decent property. And, I will say I am proud of that, because there was a lot of work that went into it. There was a lot of learning for me. And ultimately, even though mistakes were made, I was fortunate enough that we just bought it right. And we did a lot of good legwork up front, that even those couple of things that we didn't anticipate that popped up, we had the wiggle room and the leeway to make it work and figure it out. So
Makes sense. Okay. Anything that I've not asked you that you think might be valuable for viewers and listeners? And by the way, our audience is all over the place, from service people right on up to CEOs that run organizations, or even owners and co-founders, founders, and that kind of thing. So it's all over the board.
that's a good question. I think there's a lot of like initial things that come to mind that we haven't touched on yet, but I think one of the big ones that I've seen, and I think is kind of coming to bear fruit right now, was when I was at Toro. We always saw properties that would trade hands, 60s to 80s built stuff, where somebody would come in, renovate the exterior, renovate 5-10% of units for $100, $200 more, and then flip it to the next guy. And then that guy would do 50% of the units and then flip it to the next guy. And we never really looked to do that on any properties, even though you could. And I think now, seeing it, there's a lot of properties where that was really dependent upon the market being right on the exit. It's basically, a much larger scale, fix and flip. And I think while that looks great on paper because you don't have to put in a ton of capital and you can get in and out quickly, you just leave yourself really exposed. And I think a lot of people are realizing that now. So I think those opportunities are great when you're actually coming in and you are planning on actually revamping the property and making it better and improving it and doing it over time. But I think that's a much riskier business plan than I think a lot of people realized in the past. And I think than I ever even realized because, most of the properties that we did, we renovated almost all, if not all the units and pushed rent and increased NOI. And we still have a property or two that's, really struggled in the past couple of years because of what's happened in our market.
Yeah. You touched on something there that I'm curious about, maybe scratching my own itch in some ways. Sourcing parts and pieces and labor for your renovation, especially on the interior side. What headwinds and challenges? I'm sure there's some obvious ones, but maybe some not so obvious ones that you've run into, and kind of roughly what are you spending on a per unit basis for the interior renovations, and maybe a little bit of the scope, obviously, for context.
Yeah. So full disclosure, we haven't bought anything since early 2023.
Okay.
We kind of finished out our renovations in 2024. So it's been a year. I mean, we have clients that we do some stuff for, but not really. We were doing, a couple units every month on a consistent basis for a while. So I had a much better handle on kind of pricing and stuff then. I don't think it's changed too much since 2024, but we would roughly spend in around 15,000 unit on interior stuff for new cabinets, countertops, appliances, flooring, paint, and then kind of like your overall package, right? 2-panel doors, light fixtures, sinks, faucets, 2-inch blinds, sliding door blinds, things like that. Some of them were more because it was bigger. Some of them were less. Like we had some studio units we did for about like $9,000 a unit because they were 350, 400 square feet.
Right.
And then we had some larger 2 bedrooms that I think were more like 19 or 20,000. So I think kind of blended is 15 to 17. And then obviously some you have to repipe or water heaters or some other stuff. So that's in addition to that. That's more just what you're doing. And yeah, it was really struggle. One thing that really, I did it both ways. We had contractors buy the materials, and then we also had we used it was not as Lowe's Pro Supply, and then another one, I forget the name of it. And it's not the Lowe's Pro where you go into Lowe's and like sign up for our pro program. It's basically like their multifamily division where you have a guy come in, you're like, we need this, and this. They put together a package, they drop it in the unit, and then your contractor comes in and kind of puts it all together. That was pretty helpful. You get some discounts on pricing. It wasn't like, you were getting it half price or anything like that. But we get a decent discount with that. That would also let us make sure, it gave us a little bit more quality control, right? We knew what materials we were getting. We knew it was getting dropped off on the unit. We would check the condition of it beforehand. But then you'd run into the times where it was like, if we had a painter, a flooring guy, a contractor, a plumber, 4 of them come in and then something goes missing, you don't know who to point the finger at.
Right.
So then we started doing, okay, well, contractor, you're just going to supply it. And then we come and be like, that's not the ceiling fan we talked about, or that's not the blinds we talked. And then so you start running into those issues. So I definitely did not solve that by any means. My plan when I first formed the company 5 years ago was to only be an owner operator. We were going to scale to 500 million in assets under management. I always wanted to have construction crews come in house so then we could avoid that. And unfortunately, the way the markets went, I just, before we started managing third party, I probably spent, the better part of 2 years trying to find deals and make it work. We started looking up the coast in Savannah and into Charleston and even a little bit into the Carolinas. But I mean, large parts of the country, transaction volumes dropped for good reason. So it was a little bit naive to think, we were just going to go outside of Florida and find deals when there's plenty of other groups and operators already in those markets not doing deals as well. So my plan was always to try to bring more of that stuff in-house and control it more. Just never really got to that stage. So it was always a battle. I think probably if I was going to do it again, I probably would still order the materials and just try to organize it a little bit better, but it's always so difficult. It's a little bit like herding cats when you've got, different vendors in and you're trying, they've all got their own schedule or they're trying to, their guys are trying to pick up hours. They're trying not to, they're trying to get 40, a lot of times, these subs, it's not like they're a 40-hour week salary. It's, you work your hours and you get paid for what you work. So like, a lot of times that's the most important thing to them. So they're like, well, I've got 3 hours this week. I'm going to show up this week and go do it. And you're like, well, that's not what we talked about. And, so sometimes it's really a little bit outside of your control and you just make do. So, I definitely think I would probably still err towards that. And then I'd probably just throw in a greater contingency for, all those little things that are just inevitably going to come up.
Yeah, definitely. Well, before we bring it to a close here and give you the opportunity to tell people where they can find out more about your company and or you specifically, talk to us about your vision, whether it's a 1-year outlook, 3-year outlook, or 5-year outlook. What are you looking forward to?
So it's funny. I just alluded to, when I first moved down. So backing up slightly, before I even first moved down, when we were buying that first 16 unit, I had no plans of actually leaving Toro. We were just buying a property to own. I was going to hire a PM and all that stuff. And ultimately, I had a bunch of people at the time ask me like, oh, does this mean you're leaving? Because I posted about it on social media that we were under contract on something. And this was during COVID. I was working from home. And a large part of my job with Toro at the time was acquisitions. But nobody was really buying anything at that time. And a lot of deals weren't trading. So I had a lot more free time. And then nobody was doing anything up in New York. So I was just kind of sitting at home by myself. And I was like, well, what if I did go off on my own? Because that was always something I wanted to do. And I started just kind of like running that scenario through my head and what I wanted, and then built out the 10-year vision. And part of that was like, is there enough of these 10 to 80 unit properties even in Jacksonville for us to acquire? Or is there like 20 units and this is going to be impossible? It ended up working out. And I think it was still a really great activity. With all of that happening, we pivoted into the third-party management stuff, which, has a bunch of reasons into it, right? It's one, just a business for us to build. I'm not one really just to sit idle and do nothing, nor do I have the money to just sit idle and do nothing. It's not like I've got $5-10 million that I can just be like, yeah, it's fine. We'll wait a few years until the market turns around or whatever. It's a way for us to kind of grow, scale, and improve our operations. So if and when we do look at properties again, we're only better off for it. And it gives us more data, more intel, more stuff to kind of do and stay in touch with the market. So with that being said, with the pivot, I haven't really built out another longer term plan because kind of so much is in flux right now with the market and what's happening with acquisitions. So I say this loosely that right now, a lot of us we're still looking for properties to acquire. Nothing makes sense to me in Jacksonville, Orlando, Daytona, even tertiary markets around it. I can't make heads or tails of anything right now. But the plan is for us to kind of continue to grow out the management over the next few years, stay in touch with the market, stay in touch with what's going on with properties, and just continue to look for different opportunities within real estate. I still like multifamily. I still prefer it. But, if in 6 months from now, industrial for some reason just made an extreme amount of sense for some reason, I'm not sitting here saying that like I'm not one to just explore different things. Like, do I think that's really going to be the case? No, there's plenty of people in that world that already do it that know it way better than I do. That was just the one thing that came to my head quickly. So we're really trying to just see what happens over the next couple of years, build out the management side, continue to get better on the operational side. So when opportunities do come up in the future, we have a better platform to go out and make better investment decisions in the future.
Yeah, gotcha. Well, I wish you the best of luck, and I want to give you the chance to tell people where they can learn more about you and your company.
Yeah, for sure. So if anybody kind of wants to follow or connect with me, really on Instagram or LinkedIn, just search Chris Grenzig, or Bigger Pockets too. You just search me. I've got a fairly unique name, so it's easy to find. If anybody's interested in either of our companies, Jag Capital Partners is our acquisition company. So if you're interested in investing in Florida multifamily, maybe at some point in the next few years, you can check us out there. If you're looking for property management or just info, Our property management website is orlandoproperty.management. And if anybody just wants to email me, it's chris@jagpmg.com.
Awesome. Well, Chris, I really appreciate you investing a little bit of time with us here at the Multifamily Collective, which is part of the Multifamily Media Network. And I wish you the best of luck in the future.
Yeah, thanks. I appreciate you having me on.